First of all, there is this concern also by market participants, by especially regulators, like including the FCA in the UK. They are concerned that this can make markets less informationally efficient, because the idea is that actives, despite their thing that what we're saying that they may underperform collectively, they do spend some resources in collecting information about individual stocks and do price discovery in these stocks, price these stocks correctly. So if there are no active or very few active and a lot of passive, then the question is who is going to do the price discovery? So that's the general concern. And there is some evidence that the growth of passive has contributed in making stock price less efficient. Of course, still there is quite a bit of active. I mean, still active is maybe even 40% is quite a lot of active. But anyway, so that's the general concern, that the informational efficiency may suffer. Another concern, and I'm getting closer and closer to my research, another concern is that if passive is essentially the big indices, like the S&P 500, then the growth of passive will mean that money will go away from small stocks and into large stocks, and therefore large stocks are going to go up in price more. Because
of the capitalization weighted nature of the index.
Yes, and because
the most popular indexes.
And because the indices are mainly centered around large stocks, like for example the S&P 500 is the 5 largest stocks. Of course, there is also the Russell 2000 or the Russell 3000, but the more popular indices are the indices of the large.
S&P 500, even like a Vanguard VWRL is large and mid cap.
Exactly.
So, there is always a skew towards large businesses.
That's right. So the switch from active to passive can favor the large firms. That's another argument. Now, getting into my research itself, what we're showing, and we're showing this theoretically, but we also find empirical support for this in the data, is that there is indeed an effect that the growth of passive is kind of beneficial or makes the price of large stocks go up the most. And actually, this can happen even when the index, even theoretically, when the index includes all stocks. It's not just this pure kind of idea of there's a bias of indices towards large stocks, even when the indices are completely representative. So let me explain why. So to make it very, very simple, let's say that the growth of passive is just a pure switch from active into passive. So some active investors just stop being active and say, okay, I give up, I don't want to pay these costs, I want to invest into passive. So let's also assume that there is some, what we call noise traders. These are, for example, like some retail investors. Thank you very much.
What is a noise trader? A loud guy that's trading a lot, like
a noise trader is a guy who is trading a lot and who is trading maybe not in the way that maybe objectively could make good sense. So for some retail investors, for example, they say, okay, I want just to buy one firm because I'm very excited about that firm.
Because I like Elon Musk.
Exactly. I want to buy Tesla because I like Elon Musk and because he's cool and because the cars are cool. Not thinking that perhaps many other people may have had the same idea and maybe for that reason Tesla may be quite expensive.
They trade on noise.
They trade on, that's right. They trade on on noise, on something that may not be informative. It can just be noise. For example, I read this exciting thing about Elon Musk and I think he's very cool and I want to buy his company.
Vegan food is the future. Electric cars are the future. These are like examples, I think, like Beyond Burgers.
Absolutely.
Oh, Leonardo DiCaprio's bought Beyond Burgers, so I'm going to buy it.
Exactly.
And then it tanks.
That's right. Without thinking kind of about the bigger picture.
Business.
Yes. So let's say now that we have a big firm that has a fan base like that. Lots of retail investors are excited about it. And now let's say that there are some money that goes from active to passive. So these actives who are kind of, let's say, this kind of smart money, they understand some managers who are, let's say, they look at the fundamentals and they invest kind of in a sensible way. They underweight this firm that is kind of has this big kind of demand by the retail investors. Then when it goes into passive, the passives are going to hold according to the market weights. I mean, if this firm is a big firm and has a big market capitalization, they will just put a lot of money in it. So this will increase the demand for that firm. So let's say, again, let's stick with the Tesla example just for lack of a better one. So there is the price of Tesla is going to go up as there is this switch from active into passive. Now, Tesla is going to make a bigger and bigger part of the market. It's going to become a bigger and bigger part of the market. So now, for an active investor who is underweighting Tesla, who is not investing as much money in Tesla or even staying completely out of Tesla, then it will become a bit tricky for them to keep doing that, because let's say they are evaluated relative to a benchmark, or either explicitly they have to have a tracking error, they have to track this benchmark quite closely, or they know that their clients are going to look at how they perform relative to the benchmark. So therefore they say, okay, now it's very risky for me to stay underweight Tesla, because if it keeps doing well, then I will look really bad. So therefore they are going to reduce their underweight, or even a short seller might get concerned, say, now I have a big short position, now I have a lot of risk. So therefore they will buy themselves, even those people who were originally not holding much of it, and therefore this will push this price further up, and can kind of get us into this spiral, kind of more demand by the switch from active into passive. This causes these stocks to go, large overvalued stocks to go up, and can kind of create more demand for these stocks, can cause them to go further up. So this will not happen for a small stock as much, because small stocks are not a big part of the market. People don't, even an active investor, if they don't hold much of a small stock, they don't really care so much if they think that it's overvalued, because it doesn't. A small stock is peanuts. It doesn't make much of a difference in their return.
That was a clip from our chat with finance professor Dimitri Vayanos. It's all about how index funds have shaped the stock market. If you want to watch the full thing, you can click right here.